Hello, I want to welcome everyone to our Climate Strategies for Agricultural Financial Institutions webinar. My name is Maggie Monist, and I'm a Senior Director on Environmental Defense Fund's Climate Smart Agriculture team. We are in a time of unprecedented investment in climate smart agriculture in the United States, including government funding through the Inflation Reduction Act, through the Partnerships for Climate Smart Commodities program, and as well as private investment through corporations from some of the world's largest food and agriculture companies. These investments present an opportunity for agricultural lenders to support borrowers in climate smart agriculture investments. At the same time, the impacts of a changing climate also present risks to farmers and to their lenders. Understanding, managing, and mitigating these risks before they become more severe is essential to help farmers remain profitable. Last year, Environmental Defense Fund and Deloitte completed a survey of 167 agricultural finance institutions across North America, Europe, and India. The survey sought to understand how agricultural finance institutions expect climate change to impact their business, what actions they're taking to address climate risks and opportunities, and what challenges they face in taking greater action. We had 3 goals with the survey: to provide an opportunity for ag finance institutions to compare themselves to their peers, to identify best practices they can learn from, and to identify what kinds of challenges exist and how they can be addressed. The key takeaways from the survey were that agricultural finance institutions expect climate change to present both risks and opportunities. 87% of respondents expect climate change to present material risks to their businesses in the future, and 59% expect climate change to present opportunities. Some agricultural finance institutions are beginning to build internal and external strategies related to climate, but we're still in the early stages. Only 24% of agricultural finance institutions significantly integrate climate change into their business decisions, and challenges are holding back greater progress. 89% of respondents noted at least one challenge holding them back from greater action on climate risks and opportunities. We're really excited today with the group that we have. We've got my colleague Vincent Gauthier, we have Ali O'Shea from Deloitte, and we have Mariah Johnson from Farm Credit Services of America to speak with you. Please, throughout the presentations, put your questions into the Q&A. We're hoping to split our time about 50-50 with presentation and question and discussion, so we should have time to get to any questions that you have. I'll now turn it over to Vincent to talk about how we turn these learnings into guidance for climate strategies by agricultural finance institutions.
Thanks, Maggie. Good afternoon, everyone. Good morning to some of you. My name is Vincent Gauthier. As Maggie mentioned, I'm a manager for Climate Smart Agriculture at Environmental Defense Fund. So as Maggie said, we took the learnings from the survey that we conducted with Deloitte, as well as best practices from the finance industry writ large, to inform the climate strategies guide we published last month and that we'll be talking about today. The guide presents 5 strategies for ag finance institutions to address climate risks and capture climate change-related opportunities. And the 5 strategies represent a holistic roadmap for ag financial institutions preparing to address climate change risks and opportunities in their business. It's important also, though, to keep in mind that ag financial institutions in different regions with portfolios covering different types of production will prioritize the 5 strategies differently. So it's not necessarily 1 to 5 at every single institutions. They have different goals, different contexts. And so really engaging stakeholders is key to ensuring that these institutions invest in the right strategies, some of which we've presented here. We heard some of these unique situations and perspectives during a workshop we held last week with a group of ag financial institutions, where we discussed some of these 5 strategies, and we'll share some of the highlights that we heard from that workshop during this discussion as well. So as Maggie said, I'll present these 5 strategies in the first 30 minutes, and then we'll bring on Mariah and Ali to talk from their perspectives, what they see as opportunities and some of the work that they're undertaking. So the first strategy that ag financial institutions should take, and this perhaps is one that is of use to all financial institutions, no matter their their context, their types of production system in their area. And this strategy is to really understand and ensure that their leadership and key personnel understand the business risks that climate change present and the pathways in which they can really take place. So understanding these types of climate risks and how they can occur is really important for these institutions to form the right approaches to their specific geographic context and the types of production systems that they finance. As Maggie said, we found in our survey that 87% of ag financial institutions expect climate change to present material risks to their business. Some expect these risks to materialize in the next 5 years, and even more expect them to materialize in the long term. And climate change can present different types of impacts on ag production, and really understanding these different types of impacts can influence the types of strategies that ag financial institutions should take. So climate change can cause physical impacts that are acute, meaning it can create an increased frequency and severity of extreme events, such as extreme heat, flooding, hurricanes, wildfire, those types of one-off events that have serious implications to producers. Climate change can also present chronic impacts, which are those slow changes that we see and that we have seen in temperature, precipitation, season length, and that impact over time the types of production systems that can thrive in different areas. Addressing climate change can also present risks. These are called transition risks that occur when society and governments transition to a low greenhouse gas emission economy. And the risks associated with that include policy risks as governments take action to mitigate greenhouse gas emissions, market risks as borrowers, consumers, and other actors in the economy have changing expectations about products and their greenhouse gas emissions, and then legal risks, operational risks to the business. The physical and transition impacts of climate change, understanding those first is really key, but then really understanding how they can lead to business risk under the traditional risk categories is really important. So lenders, from the climate impacts that we can expect to occur in the future, lenders can face credit risks if their borrowers are unable to consistently produce effectively, given the changing weather and precipitation patterns, which can impact the amount of revenue they're able to make and their ability to repay the credit offered by the lending institutions. Ag lenders can also face market risks if they are starting to lose customers to other lending institutions that are providing more tailored financing to help them invest in adaptation to climate change. And ag lending institutions can also face operational risks if their systems and their offices are not prepared for increasingly severe storms. We're going to put out a poll for you all to respond to. Really interested to hear your feedback and get some insights from your area. So April, if we could launch that. And the question is, what potential impacts from climate change presents the greatest risk to agriculture in your area? Acute physical risks, like we talked about, the changing in the frequency and severity of severe weather events, chronic physical risks over time, slow changes in temperature and precipitation, or transition risk, impacts of changing policy, markets, and technology as societies move towards a low greenhouse gas emissions economy. We've got some responses coming in. It's a tight race. Give about another minute or so, and then we'll close it out. It's interesting for Maggie and I think probably others of you on the line who get to visit different areas of agricultural production and the different changes in weather they've already faced. In North Carolina, we've talked to producers that face a lot of impacts from increased severity and frequency of hurricanes. In other areas, impacts of longer and more severe droughts are of highest risk. So April, let's close this out and see what we got in terms of results. Okay, so it looks like we've got a pretty even split
That was a tight one.
That's really interesting to see. So we've got about 30% of folks saying that acute physical risks present the greatest risk to ag in their area, 35% for chronic physical risks, and 35% for transition risks. Really interesting to see an even split between those three across what I'm sure is a wide range of areas.
I wonder if we took this poll like a few years ago with the derechos being front of mind, if that would have come out tilted another direction.
Yeah. I'm sure this is influenced year by year. Well, thanks for all of you that participated. We will continue on with the session. So the second strategy, first, as I presented, really understanding the types of climate impacts that can influence agricultural production and how that materializes into business risks to the financial institution is really critical for leadership and for key personnel to understand to build out the rest of the strategies. So the second strategies for ag financial institutions can implement is to measure and evaluate climate risks in their portfolio. In EDF and Deloitte's survey, we found that 83% of ag financial institutions expect climate change to impact the financial situation of their clients. About 42% said they expect their borrowers to have higher probability of default, 32% expect higher loss given default, and 28% expect diminished collateral value from the impacts of climate change. So really evaluating climate risks of the portfolio in greater detail can help these institutions better understand how these risks are likely to emerge, how severe they will be, and then adaptation scenarios that the lenders can help finance and help their borrowers adapt to climate change. So the faster that ag lenders understand the climate risk, the more likely they can turn those into opportunities by helping their borrowers and other key stakeholders in the area develop those solutions and invest in adaptation. Climate risk assessment approaches have been used by financial institutions and public and private companies in the past few years in other sectors and other regions, and these approaches can be adapted for effective use in ag financial institutions. So we're really not starting from scratch in this solution. And this process takes 5 steps that we'll outline here. First, the ag financial institution can use their understanding of climate risk to heat map climate risks based on their loan portfolio's vulnerability to that type of impact, to the type of way that climate change can impact their borrowers, and the level of exposure, the amount of borrowers within their portfolio that are exposed to that risk. Based on the results of that heat map exercise, ag financial institutions can select a climate risk that is of most importance, that may present the greatest impact to their portfolio, and the type of agricultural production system that is most likely to be impacted and most exposed to that climate impact. The second step is then to choose a sample of borrowers from that segment of the portfolio and work with them to gather production and financial information to use as the baseline for the assessment. The third step is to choose the climate model that represents the type of future that the financial institution wishes to assess, and picking a time frame for the assessment that is information that provides the right type of information based on the relationship and the time frame of that relationship with the borrowers in the portfolio. After that, you can use the outputs of the climate model and run them as inputs into crop models that assess the productivity of crops under different weather, planting, and fertilization conditions. So we can see how a changing climate in a specific area actually impacts the productivity of crops as they are grown, the type of planting date, fertilization that is used today. And this will show us how the production of that given crop will be impacted by climate change over time. And the last step in the process is to translate the impacts of productivity onto financial performance. So ag lenders, in collaboration with a partner or consultant, can build out a model that evaluates how impacts on productivity, inventory, input costs, et cetera, impact the profitability of the borrowers assessed. And then that financial performance can then be used to measure the impacts on credit risk on the credit risk model and the probability of default of that portion of the portfolio. So with this process, the ag lending institutions can really understand in great detail how a type of climate impact is likely or projected to impact a portion of their portfolio and what that means for the credit risk and the probability of default of those borrowers. The third strategy that ag financial institutions can implement is to establish climate change responsibilities, procedures, and goals within the way they operate, the same way that they would build in those responsibilities for other topics of importance. In our survey of ag financial institutions, we found that 43% of US ag financial institutions have an ESG-focused employee, and that about 22% have a climate change focused employee. This shows that there's really an opportunity for ag financial institutions to build out these teams, build out these new responsibilities, and really build this within their operations and their internal processes. Ag financial institutions can do this by taking a simple 3-step process that we identified in the guide. First is really identifying the processes and responsibilities that are required to manage climate risks and climate opportunities within their current structure. Then the second step is to assign those responsibilities to a role or department. And then the last step is to document the process, set up a reporting structure, and start really implementing the roles and responsibilities and procedures within the organization. The processes and responsibilities, though, themselves to manage climate risks and opportunities, they can include a few different things. So, for example, executives can set climate goals. They can take responsibility for responding to external stakeholders, and they can make strategic decisions about climate risks and opportunities. From a middle management standpoint, their responsibilities can include measuring climate risks like we just presented, engaging customers on climate risks, and developing new financial products and solutions that really help borrowers adapt. And we'll be talking about some of those roles and responsibilities within the next few strategies. So the responsibilities and roles needed to manage a climate strategy really depend on the organization's current structure and where they want to build in those roles. So potential pre-existing governance teams and roles can include the risk management committee of the board, the chief sustainability or risk officer, or the executive management team. The types of roles can include head of risk or risk managers within the climate risk team, and some institutions can even build out things like climate risk working groups within their steering committee that may be new or build on their existing structure. But it's also important to understand that for smaller community banks that finance agriculture, setting this type of robust governance structure and responsibilities may not be feasible given their resources and their staffing. So the approach that can support them is really to build this type of roles and processes collectively within the level of their associations in ways that they collaborate already. So, many of these types of community banks don't have the current resources, and really building them into the associations that they're part of and learning in collaboration with other community banks across the country, building resources collectively can really help them overcome some of these resource constraints. So building in these processes, these roles can really help an institution build a complete strategy for climate risks and opportunities. The fourth strategy that we outline in the guide that ag financial institutions can take is to engage customers on the topic of climate change. One thing that came out multiple times in the workshop that we did with ag lenders last week was that ag lenders have a unique role as a trusted neutral advisor to producers, and that the participants in the workshop really shared that borrower education and convening could be a great first step for them to build in their climate strategies, since they are that trusted advisor to their borrowers. They can help their their borrowers navigate different market opportunities related to climate, different types of grants, different types of partnerships, and they're really seen as a trusted advisor by their borrowers. In our survey last year, we found that 44% of ag financial institutions think that a lack of client demand is holding back their level of action on climate strategies, but that 60% of survey respondents think that an increase in client demand would be a strong motivating factor for them to do more, build out more strategies, and better support their producers. But ag financial institutions can kind of create that demand by proactively engaging their customers on topics of climate risks and opportunities. So building out that type of engagement can help them share with borrowers that they are building out these internal strategies and providing that support to their customers. And by building out this type of engagement, relationship management teams can better understand their customers' awareness of climate risks, the specific needs that they have related to climate change risks and opportunities, and that localized context about the physical risks that producers are already facing and already adapting to, and really understanding within the portfolio the types of climate adaptations that producers are trying out and testing. So properly building out this engagement with borrowers on issues of climate risks and opportunities first requires leaders within the institution to prepare their relationship management teams or their loan officers. So they can start by equipping loan officers with the knowledge and resources that they need by doing things like offering climate risk and opportunity trainings, workshops. They can bring in external presenters from land-grant universities, other types of expertise on climate risk and opportunities that really bring expertise and knowledge to their loan officer teams from external resources. They can also provide resources to their loan officers that they need to engage borrowers, including, talking points on the basics of climate change, information on the climate impacts that are most prevalent in their area and for the different types of production systems that they finance, and practices that some of the borrowers within their portfolio are already undertaking to adapt to these changes. They can also provide resources about the types of funding programs that are available in their area that farmers could participate in for greater investment in these practices, technologies that can help them adapt and prepare for climate-related impacts. So once the loan officers are trained and they're provided with resources, they feel confident in engaging with their borrowers, the ag financial institutions can then begin that engagement process. So the first thing that they can do in that is really to identify the right customers to engage. And that can be decided upon based on different things. It can be decided based on those that are most open to having that discussion so that the lending institution can learn, how their borrowers are responding to this engagement. Lending institutions can also choose to prioritize the types of production or the areas that face greatest climate risk, or which could benefit most from incentive programs that are present in their area. The institutions can then develop an engagement plan, first piloting it and understanding how the types of responses that they're getting from borrowers, and then really outlining the types of channels of communication, whether that be through existing channels like directly through loan officers, perhaps at borrower or at customer events, or through a new process if they think that that's the best way to engage and communicate. And it's really important in these circumstances to build a feedback process, since it's something new. It's a new topic that the lending institution is engaging their borrowers on, really ensuring that they're hearing back and adjusting their engagement based on the responses that they're getting from their borrowers. So this is a really key element for ag financial institutions to begin to show to their borrowers that they're proactively there to support them in climate adaptation and presenting them opportunities related to climate incentive programs and other opportunities. So finally, we get to the fifth and final strategy that ag financial institutions can take, and that's to develop new or modified financial products or solutions that help their borrowers invest in climate mitigation and adaptation efforts. We found that 88% of ag financial institutions expect their borrowers' financial needs to change due to climate change in the future. 88%, that's pretty significant. So in the US, 42% expect their borrowers will need higher working capital because of climate impacts. 36% expect their borrowers will need longer-term loans. 34% expect that their borrowers will need higher loan guarantees, and 28% expect that their borrowers will need lower interest rates to deal and invest in adaptation to climate change. The institutions can support their borrowers by offering new or modified financial products and solutions that help them manage climate risks or take advantage of climate-related opportunities. This can help improve the borrower's position as well as the position of the entire portfolio by improving the credit risk profiles as producers become more resilient to climate impacts, and transitioning to climate smart agriculture practices can help reduce greenhouse gas emissions in the portfolio and help producers participate in emerging markets, providing new opportunities for them. So the approach to developing new or modified financial products should really build from the finance institution's understanding of climate risks presented in the strategies previous to this one, and the opportunities that are in front of producers in their area. So the types of practices, technologies, and production shifts that are needed is really key. Like understanding those is really key to then, tailoring those financial products and solutions that help producers mitigate risks and capture opportunities, and really help overcome some of the financial barriers that producers may have in making those new investments or transitioning to different types of agricultural production. So in the panel, we'll talk about some of these more concrete examples, but generally, examples of new or modified financial products include green loans you may have heard about, whose proceeds must be used to fund a sustainable project. It can also, other financial products can include sustainability-linked loans, whose interest rates are reduced if certain sustainability targets are met. And then transition loans are those that have adjustment repayment structures that actually help producers through short-term risks, costs, or decreases in productivity with long-term benefits and improvements in the producer's resilience and overall productivity. So just to share, during the workshop last week, participants shared that many climate smart practices may not require a specific financial product itself, but instead require modified financing that some of the lenders are already doing. But in these cases, it's really important for the financial institutions to take a proactive approach, and by documenting these practices that their loan officers are taking to successfully finance transitions, and really share with other loan officers and other institutions these best practices so that more lending institutions and their loan officers have an understanding of how they can help their borrowers make these transitions and really make these investments in climate resilience and climate mitigation. So just to recap before we go into the panel, the 5 strategies that we have outlined in the guide that we see as a really strong roadmap for ag financial institutions to build out a holistic climate strategy. So first, they can ensure that their leadership understand the business risks presented by climate change. Second, they can measure and evaluate climate risks in greater detail to understand what risks are present in their portfolio and the types of adaptation that can help borrowers become more resilient to those climate risks in the future. Third, they can establish internal processes, roles, and responsibilities to help build out their internal strategy. Fourth, they can engage with borrowers on the topic of climate change and help them understand climate risks, opportunities, and adaptation solutions. And then finally, they can develop new offerings to help borrowers address risks and opportunities. And with that, we'll transition it back to Maggie, who will introduce the panel.
Thanks, Vincent. So we're going to bring in some real examples of these strategies in action. And as we do, please add your questions to the Q&A because we'll get to those afterwards. So first, I would like to welcome Mariah Johnson, VP of Corporate Sustainability at Farm Credit Services of America. Mariah, please tell us a little bit about Farm Credit Services of America and the journey your organization has taken on to establish a sustainability strategy.
Absolutely. Thank you, Maggie and Vincent, both for letting me be here today and share a little bit about what we're doing. So Farm Credit Services of America and Frontier Farm Credit are financial services cooperatives, and we provide credit and insurance services to farmers, ranchers, agribusinesses, and rural residents. And as a cooperative, we are 100% owned by our customers. And our associations are also a part of the greater U.S. farm credit system. We have 48 offices, and we serve Iowa, Nebraska, South Dakota, Kansas, and Wyoming. And so as you can imagine with that, we have a pretty diverse portfolio. And so that would include commodities such as grain, beef, cattle feedlots, cow-calf, swine, dairy, poultry, eggs, fruits and vegetables, forest products, and the list goes on. And so really, when we think about the journey that our institution underwent back in 2021 or so, several of our folks began receiving questions. And at that time, they were really revolved around carbon markets. And as many of us know, that's been an area that has felt like the wild, wild west, right? And so our customers didn't necessarily know who to turn towards with questions around the carbon markets and really just around environmental sustainability. And so as these questions began to come in, the associations decided to take a step back and to really evaluate what was the need and what our customers were asking for. And so they put together a cross-functional work group that underwent about a year-long study about where should we be as an association. And so that association came up with a few different recommendations. One of those recommendations was to hire my position, and that's how I got to be where I am today. But that cross-functional group also affirmed that as a financial services cooperative, our job is to finance and insure agriculture as it comes. We do not and we will not prescribe production methods to our customer owners. We know that those are individual choices best made by each producer. However, we also know that when our customers succeed, we succeed because we are a cooperative and we are our customers. And so our work group also helped to form our sustainability priorities, which are in 3 different areas. So we're committed to educating our customers about opportunities, trends, and challenges in sustainable agriculture, and to enable our customers who choose to participate in sustainable practices through specialized products and programs. And third, we'll engage with third-party organizations to collaborate on partnerships and new opportunities that we believe will bring value to our customers, our associations, our communities, and to agriculture more broadly. And so today, I work with an internal sustainable ag committee that helps to define and implement those strategies. And so that group is, again, a pretty good cross-section of our business. And so I have expertise there from not only our portfolio analysis and reporting to our education teams, communications, lending, and beyond. And so we recognize too that agriculture as well as sustainability are constantly evolving and that efforts will continue to evolve and expand, but our dedication to helping our customer owners success and thrive in changing times will remain constant.
Thanks, Mariah. And we just put your first sustainability report in the chat, so folks can check that out as well. It's really helpful to hear how your organization got here and your current priorities. So shifting back to Vincent, many agricultural finance institutions don't have a great understanding of climate risks and how they could manifest in their portfolio. What opportunities do you see to help ag lenders better understand and measure climate risks to their businesses?
Yeah, Maggie, it's a really great question, because I think, ag lending institutions, this is a new thing to really, for them to understand and really measure in great detail climate related risks. And through that process, I think more importantly, identifying adaptations that they can support their borrowers with, as well as support, the regional stakeholders, whether that be, in collaboration with food and agriculture companies that source from their region, or land grant universities that are leading research and understanding climate risks to agriculture, really understanding those adaptations to the risks that are present in their portfolio can really be action oriented for them to work with their borrowers and other stakeholders. So the greater financial services sector has done a lot to develop frameworks, models, tools to understand climate risks. A lot of those being in sectors that are, really at risk from climate change, such as oil and gas and the real estate sector. But those tools aren't necessarily well adapted for understanding the granular impacts that climate change will have on farmers, ranchers, agriculture production, and as they roll up to agricultural lending portfolio. So a lot of the work that's been done by banks and other financial institutions in other real economy sectors has been done in a collaborative way through initiatives run by organizations like the UN Environment Program Finance Initiative. And through those collaborations, those banks have come together to identify their needs, the types of data that they need to use to understand climate risks, and the types of tools and models that can help them with their strategy building. And a similar type of collaboration, I think, is really needed for agricultural finance institutions to ensure that we can take some of those tools, take some of those models, and really translate them and make them, granularly insightful for agricultural lending institutions. And I think, this is a really great opportunity for collaboration, and really not starting from scratch, really building off of some of the tools, some of the frameworks that other financial institutions have already developed, but really connecting them with the types of data, the types of models that we have in agriculture to really understand how weather and climate can impact crop and livestock productivity. I think there's a real strength in agriculture lending to connect some of those models from, that are more on climate and understanding how climate impacts companies, with biophysical crop models that help us understand how climate actually and different weather impacts can impact the production of crops, and what that means for yields, for inputs, inventory, and how that in the end impacts the financial performance of producers, that then ag lenders can package together and understand how it impacts their portfolio level risk, and where there are, hot spots, in terms of risks that they can help their borrowers overcome.
Thanks, Vincent. I really agree that this is one of those areas where we need collaboration and external support and partnership and helpers. Now, Allie, as one of those helpers, I want to bring you in because at Deloitte, you work with financial institutions on climate and sustainability strategies from institutions from many different economy sectors. I'd love to hear from you on specific solutions you're working on across the strategies that we outlined in the guide.
Yeah, definitely. Thanks, Maggie. It's great to meet everyone. My name is Ali O'Shea. I'm part of Deloitte's sustainability practice, as Maggie mentioned. For those of you who may not be aware, Deloitte's sustainability practice is really focused on helping organizations align their business objectives and their sustainability goals, and really taking into account as we do that, how customer demands are changing, consumer preferences, as well as the regulatory environment. And my work specifically is focused on helping financial services clients in this space. And so a lot of what is being discussed today is immediately relevant to our clients. And we're seeing that in the marketplace every single day. So I'm happy to talk through maybe just a few examples of what we're seeing. And I'll bucket this into three big groups of work. So one, we're seeing a lot of clients seeking support around baselining, and I can talk a bit more about what that means in a minute. We're also seeing a good amount of work come up in terms of understanding operational enhancements that can be made to the business, and then also thinking through new products or innovations, as well as some ecosystem engagement, which has come up a couple of times now. So from a baselining perspective, maybe I'll just start there and say, when we talk about baselining, what we really mean is trying to understand where the organization is at today and understand what risks and opportunities exist. So a lot of what this entails is just getting an understanding of where the organization is at, and then also looking at things like different incentive programs, such as the IRA, that exist in the marketplace, and how, a financial institution's customers may already be taking advantage of some of those. As I'm sure a lot of you are aware, the incentives in the IRA, for example, are meant to really spur investment in a variety of different practices, but they do still require private capital. And I think that's where financial institutions can kind of come in and play an important role. From a baselining perspective, we're also helping organizations make sense of what is material to their business and what reporting frameworks may also be most relevant. And we do a number of awareness trainings for clients as well. So again, just helping them make sense of the various opportunities in this space and how those opportunities can be tailored for their particular business, because no single institution is the same. And I think getting that right fit with, your sustainability goals and your business objectives is really what's most important. And then from an operational enhancement perspective, we're seeing a lot of clients come to us asking for help, sort of pressure testing their portfolio. So this goes back to the discussion we were having earlier around physical and transition risks, and clients are coming to us to help them model those physical and transition risks and understand where they may be most exposed. And I would say some of this is in reaction to regulatory pressures, but a lot of it is also just being done from a strategic perspective as well. Clients are really interested in understanding what is the opportunity here to make their portfolio more resilient. So when you think about things like physical and transition risk, having a lending base that is more resilient to those changes is going to ultimately make them a better financial risk as well. So we do a lot of work helping organizations think through what that could look like and where they may be most exposed. And again, the intention here is not to stop serving any particular customers, but think about how we can partner with our customers to make them more resilient over time. We also do a lot of work in this space around climate governance and strategy, and helping organizations actually develop the policies, processes, and controls required to implement a lot of these practices. And we have a pretty large technology practice that can help with getting this into the systems as well. And then the last thing that I wanted to talk about was just the new products and innovation. So we're seeing a lot of work start to come up around new products in this space, some of which I would say are fairly net new, others which are really about tailoring existing products or lending solutions that exist in the marketplace today. And so some of what we're seeing here, for example, includes things like sustainability linked loans, where the interest rate is tied to the borrower's achievement of certain ESG targets. We're also seeing social and green loans come up here as an important way to fund specific projects, especially often those that are, again, incentivized by some of those regulations that are coming down the pipeline. And we also do some supply chain work here as well, again, bringing together the ecosystem of players to make sure that we are really enabling everybody across the value chain to play a part in this transition and also reap the benefits of that. So we have done some work in that space, as well as kind of helping think through different ag sector innovations that could really help kind of move the industry along as well. And so I'm happy to also just talk through a couple examples. I'll say we work with a lot of clients in this space, some of whom I'm sure you're familiar with. I'll focus on just a handful here that we are able to share. So we can't, share all of the details of our client names, but a couple examples of some clients that we have worked with, for instance, include our 100 Million Farmers Initiative, which is a partnership with World Economic Forum and U.S. Farmers and Ranchers in Action as well. And there's some big companies that are involved in that program, such as Tyson's. And through that work, we're really helping to identify new financing mechanisms, help with the transition of agriculture to climate smart practices. We also have a big program with USAID and the World Bank around coming up with various competitions that can incentivize innovation in agriculture. So not putting a lot of specifications around what needs to be done, but really allowing the market to put forth innovative solutions that help to achieve the objectives that were collectively agreed upon. We also do a lot of work with Aspiration Bank, which initially started off in the credit card space, but now has transitioned to focusing quite a bit on offsets. And so we're a big strategic partner of them as well. And then USDA is another organization that we partner with on a variety of different food sector plays to help them think about how can we transform supply chains broadly. And so again, this is just a small sampling, but there are countless examples that I think align really well with the discussion today in terms of how organizations are thinking about making changes to their business from, those early stages around understanding how climate change is relevant all the way through new offerings and opportunities as well. So it's great to be here. And like I said, really, really interesting.
Thanks so much, Allie. And I'm glad you landed on, some of the new business opportunities and lending solutions that ag finance institutions can use to, connect with their customers in a variety of ways. Because we're seeing a lot of action in that space, especially over the last couple of years. I put in the chat another report by Field to Market's Innovative Finance Committee, of which I serve as the co-chair, that we released last year, and that had, I think, 12 different examples of tangible, innovative financial mechanisms in the ag finance space aimed at sustainable practices. EDF has also collaborated with Farmers Business Network on an operating line that has an interest rate rebate for farmers that meet environmental standards for nitrogen use and soil health practices. And I just saw another announcement the other day from Farmer Mac and Indigo. So things are coming out all the time. And this is a great opportunity and time for all of us to learn from some of these early examples and see what works for producers and see what works for lenders and what there should be more of. So we're going to move into the Q&A. I see we have one question. I'm going to take moderator's privilege, though, and ask one of my own first and mix up our planned order a little bit. So speakers, you're warned. So Mariah, I wanted to start with you. In our workshop last week, and I've also heard it from many others, some lenders have shared concern about discussing these topics with their borrowers. What has your approach been, and how do you think lenders can begin engaging their farmer clients on some of these subjects?
Sure. I do think it is, and it has been a touchy subject over time, where certainly folks come in with their biases, right, around these topics. And so where I've always tried to start with is just that common ground of, we all have this common ground of we want to be better. We want things to be better tomorrow than they are today, and to leave our resources better than they were when we received them. And I think that's a pretty common ground that rings true with a lot of our customers. And so that's where we start. And I think too that, as I've been involved in the agriculture industry over time, we've always been interested in weather, right? Maybe we don't talk about it as climate, or the climate change or any of that vernacular. And we talked about this some in the workshop last week, right, Maggie? Is that, knowing the context of who you're working with. And when I attend conferences and there's a weather forecast outlook session, that is the #1 topic that we see producers attending, because we want to know what that shift in the pattern is. Do we have El Nino or La Nina coming for us? And how can I, as a producer, be prepared and adapt to that to make the best decisions for my operation? So I think that's a place that we can really start with, and that is maybe less threatening, right? Than some of the other ways that others have gone about it. So that's a lot of our common ground. But I think the other piece that's really important, and I appreciate that Ali has said on and has been talked about throughout this webinar, is approaching this as partners, right? So I talked about that as a Farm Credit, we are 100% owned by our customers. And so when they succeed, we succeed as an institution. And so we want to partner with them to help them make their operations more resilient and more robust. And we're not looking at this as how can we pinpoint risk and how can we price that to our customers? Because when we think about the climate, I have no real impact truly, right, of the amount of rainfall that happens on my farm and ranch. I can't, as a single individual person, influence that in a really big, impactful way. And so it's unfair to price that risk to that customer. And I think customers have concerns about companies doing that, or that lenders will walk away from them. And so we have to start that conversation saying that we're here, we're in it, and Farm Credit is going to be in this. And we're looking to be that partner to help them make that impact that they need and to go through this journey together. And so where we think that we'll fold a lot of this in is through our customer education efforts. And so as we understand these impacts more fully, we'll use that to help our customers prepare and adapt.
Those are great points. And we also see a lot of lenders starting with a lot of the farmer leaders that they already know are doing a great job of adopting these practices and going to them and asking about what works well for them and learning from them. And then trying to spread those examples out more widely. On a somewhat related topic, we had a question in the chat that is about the relationship between crop insurance and ag lending on these issues. Now, I can certainly say that those two topics are very closely related. The farm safety net is really important to the farmer having credit. A lot of times it's either required or it's strongly recommended that the farmer has crop insurance in order to get their loans. But at the same time, crop insurance does not make a farmer whole. It's not designed to. And so, repeated disasters can kind of erode a farmer's financial position over time. And so, I like to say that, crop insurance is a really important tool, but it does not solve climate risk either for farmers or for their lenders. And there's been some really interesting research out lately around the interplay between some of the more resilient practices like soil health practices and crop insurance that is surely of interest to both insurers and lenders. For example, there was a great report out recently from the Agree Coalition that looked at prevent plant claims after the 2019 really wet spring and floods. Finding reduced prevent plant claims and also farmers being able to get back out into the field more quickly. And so there's starting to be real big data evidence of how some of these soil health practices can actually reduce risk, which matters for farmers, for insurers, and for lenders. So, that's what comes to my mind. Would anybody else like to add anything to that?
I think the only thing I'll add, Maggie, is as we think, of risk in the long term and different impacts that climate change will have on different areas of production, what we want to ensure is that producers have, the risk management tools that they need to, as they have in the past, to deal with the year-to-year variability. But what we also want to ensure is that there are investments taking place that reduce the long-term underlying risks of production systems and production practices adapting to the changing temperatures, the changing precipitation, the changing extreme weather events. So both can happen in parallel, where the tools are still available to producers to deal with that variability, but at the same time, those adaptations taking place and the investment in those adaptations taking place as the trends begin to change and continue to change in terms of precipitation, temperature, and other chronic impacts that climate change will have on different production regions.
Thanks. I'm going to go to a question that I think everybody probably has their own answer to. I'm wondering what data, resources, or tools do you think are needed to help ag lenders build their climate strategies? Allie, maybe we can go to you first.
Yeah, sure. Thanks, Maggie. So I think the answer is there's a lot of data, resources, and tools that could help, financial institutions start to build this strategy. When we work with clients, we typically try to start with what data do they already have. And I think a lot of this is already within the organization. It's just a matter of getting that. And then there's an abundance of resources externally as well that you can use in partnership with that internal data to make sense of what's going on. So you can take things like publicly available emissions factors to get proxies for, your carbon footprint. And there are ways that you can pair that data together that really can help lead to a lot of insights. And I think the key here is identifying what are those risks and what are those opportunities from that data set, and then kind of structuring from there, the strategy in terms of where you go next.
Who else has an opinion on this one?
I would just echo what Allie has to say. Really, we're trying to go through that process of cataloging what do we have on hand and what do we not, because as a financial institution, we try to keep that information very limited in terms of what we collect. And so I think sometimes there's some assumptions around what we have lying around. And we don't always have that, so making that inventory and then seeing where we can fill those gaps through that publicly available information.
Yeah, I'll just reemphasize a point that I made earlier, which is that a lot of the larger commercial banks, both in the US and globally, have done a lot to build out tools and resources to understand climate risks, to pinpoint climate opportunities and adaptation opportunities. And so it's really more of a case of adapting those to the specific situation and conditions of agriculture production and the regional impacts and types of production systems that are present in the portfolio. So I think it's a lot of building off of some of the resources that other financial institutions have done, and really making it ag specific, because ag lenders, are a lot of them only lend in ag or primarily lend in ag. And so really making it specific to the work that they do will help make it much more impactful and action ready for their institutions and their strategies.
Thanks, Vincent. Now, to wrap up, we've talked a lot about risks. We've talked a lot about opportunities. I would like each of you to share one opportunity that perhaps you're particularly excited about in this space and you see as, a real opportunity for yourself, your organization, or others in the next few years. Who wants to go first?
I'll jump in since we only have a few minutes left. I think I'm really excited to work with ag lenders to identify within their area the types of adaptations, the types of technologies, types of practices that can really help build resilience within their borrower base, and identify what role they can play in supporting their borrowers with the right type of financing that makes those technologies and those practices really profitable to them as they adapt to changing conditions.
I agree there, and I think too, the piece that excites me in the opportunity is this, the chance to keep this holistic, right? A lot of times environmental sustainability is talked about, but as this financial institution, we have the opportunity to keep that financial or that economic piece really front and center with it, and keep those linked together, because we can't do one without the other. And so I think I'm really excited about that opportunity to make sure that we just continue that work.
Yeah, I would echo everything Vincent and Mariah said, and also add, I think the opportunity for collaboration here is really interesting and exciting. I think one question that we get a lot from financial institutions is, what can I do? And I think the good thing is there's so much already going on by a lot of big players in the ecosystem, including, organizations with complex supply chains, grower associations, and there is a lot of opportunity to really bring these partners together and do something that's mutually beneficial for everyone.
Couldn't have said it any better than that. Thank you all so much for speaking. Thanks to everyone for attending. This was recorded, so it'll be on our website soon. And please do check out all the links in the chat. Thanks, everybody.